With inflation falling fairly rapidly, already at 3%, is it time to rethink commodities? Hello, my name is Paul Carroll, the CEO and founder of Avion Wealth, an elite wealth management firm here in South Texas. So let's begin by defining commodities. They're basic goods and raw materials typically sold on specialist exchanges. We're talking about oil, gold, wheat, pork bellies. And there's a number of ways we can own these commodities. 4 fundamental ways to own commodities. First, we can just own the commodity, direct physical ownership. That's a bit of a pain. Gold coins may be the easiest, but you've still got to buy them. They usually have a pretty big bid-ask spread when you buy a coin, and then you've got to store them somewhere safe. If you want to buy a barrel of oil and bet on the oil market, you've got to figure out where you're going to put those 55-gallon drums. Most people don't want to deal with transaction costs and storage, so they engage in what's called futures contracts. Futures contracts are a very, very efficient way to get commodities exposure, but there's a drag. I don't want to call it a tax, but there's a name for it. It's called backwardation and contango, and it causes the futures contracts over time to not be quite as valuable as the underlying commodities. And then we have commodity stocks, and by that I mean just companies that own commodities, that mine them, that pull them out of the ground. Oil companies, gold companies. We already, though, have significant exposure to those companies within our traditional investment indexes. So when we buy those separately, we're increasing our commodity exposure. And finally, there are commodity ETFs and funds. And because of the aforementioned problems with direct storage, they tend to be full of commodity stocks and financial futures. So what's the benefit of commodities? They're a great inflation hedge, especially in times of runaway inflation. And when we didn't know where inflation was going, we felt it was very important to get it. In fact, for a couple of years, the returns were fantastic. They're also a non-correlated asset class. In English, that means they reduce the risk of the overall portfolio, because when stocks go up, they may come down, and vice versa. There are downsides to commodities, though. Transaction costs. We've talked about the drag that comes with financial futures. Geopolitical risks. There are also downside risks that come with commodities. Reasons to not always have them in a portfolio. First and foremost, transaction costs. Futures have their own drag. We talked about that a little bit. There are geopolitical risks, storage costs we already discussed. And finally, most misunderstood is, even though in nominal terms commodities go up in value and up in cost, in real terms, after correcting for inflation, they actually tend to drop as we get more efficient at mining and producing those items. So what's our strategy? The usefulness of commodities from an inflationary perspective is now behind us. So we're trading out of our commodity positions. They've done their job. We've waited to capture the most recent healthy dividend. And now as we trade out, we're looking for tax loss harvesting opportunities and just an efficient exit. Commodities, from our perspective, are not long-term holdings. They're tactical holdings in periods of uncontrolled inflation. We wish you the best of non-inflationary investment success. Thank you.